All right, welcome back to our market outlook video here for today, finishing up the week today, but the markets did not finish up on a high note. Today we're talking about a sharp defensive rotation again. We've been talking about this defensive rotation for the past, over a week now, and it kind of hit its head today with tariff news. Again, fresh tariff threats from President Trump rattled investors. The S&P 500 fell nearly about 2/3%. Small caps, mid caps under more pressure than that. At the same time, we saw defensive sectors like utilities and staples emerge again as today's leaders. Volatility, measured by the VIX, of course, jumped almost 10% today. Again, kind of building on what we saw on Wednesday. Commodities found support today. Gold, silver, copper all rallied. The dollar took a big step back. Even crude oil rallied nearly 1%. So these moves tell us a lot about what investors are how investors are navigating uncertainty and looking for some stability there. So in today's market outlook, I'll break down these shifts in sector leadership, what they mean for the broader market outlook, and why investors are bracing for more turbulence as we head into this holiday weekend and afterwards. So let's go ahead and get started. Today is Friday, May the 23rd, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. Manage them. And we also put on today's trade already before the market close. You can receive these market outlook emails by filling out this form right here and then clicking on signing up, or you can do it up here as well where it says subscribe free. Scroll to the bottom, you can see this tweet down here. Click the heart. It opens up this tab. Hit that like button. Click on this thumbs up icon. It opens up this tab. Looks like for some odd reason the link's not working there, but you can see the like button there too that you always see on these. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the S&P dropped 2/3% today, down almost 40 points. You can see the intermediate line is falling, still easily in the upper reversal zone, however, so above the 90th percentile. Market sentiment has crossed above the midpoint of the chart. They're the 50th percentile, so that's a good sign. We're still more than 2.5% above the moving average despite the drop. The short-term sentiment's oversold, but at least it rallied. Like it actually, both lines moved slightly higher. And again, they're still both oversold, but at least they moved slightly higher today. And so it was, relatively bear. Obviously, it was a bearish day, but it wasn't that bearish, right? We didn't fill in this gap very much here from last Monday. So that's a good sign. All right, that's a good sign for the markets. We basically have just retesting that post-gap low point, and really so far nothing more than that. And that's kind of the same thing you see on the NASDAQ 100 as well. The intermediate posture is actually still very strongly bullish. The posture and the short-term sentiment is not even oversold. So the near-term line and the momentum line are actually still sitting right around the 20th percentile. The near-term line's above it at 21. And we're still 5% above the moving average there. So we have an opportunity to rebound next week. The Russell 2000, its intermediate line is still in reversal zone. It's a little bit closer to the moving average, only 2.5% away. But its short-term sentiment has rebounded out. So we gapped down more. And we finished flat, relatively flat. We finished at 2045 down to 2039 here today. It's about 6 points, a very marginal loss there on the Russell 2000. But at least it brought the short-term sentiment higher. Market sentiment still not out of bearish territory yet. And then finally, when you look at your Dow Jones Industrial Average, its short-term sentiment, like the S&P, is still oversold. Its intermediate line, like the Russell 2000s, is below the 90th percentile. Still overbought, still in the upper reversal zone, but just not as bullish. Market sentiment's rising, but not crossing the chart's midpoint yet. Again, similar to the Russell 2000 in that regard. So it was a down week for the markets. We had clustered right? Most of these indexes got clusters on Friday. The Nasdaq got it on Monday of this week. We got that overbought cluster, and we have near-term decline this week. It's pretty much all this is as of right now. All this has been a relatively strong near-term decline, and nothing more than that. If you take a look at some of the other some of the other charts like Bitcoin, Bitcoin, you can see like had a down day today, down 2.75%. The near-term line dropping, the momentum line getting oversold, but again, the near-term line still in bullish territory despite the drop. Now, we've seen a couple of drops so far on this intermediate decline where the near-term line got to the pretty much the 60th percentile and rebounded. And we'll see if that ends up being the case again, especially considering, again, over a bullish intermediate confirmation signal with this oversold momentum line. Take a look at the dollar index. Oops, here we go. The dollar index, you can see down again today. The dollar had a bad week this week, really, really rough to the downside. The intermediate line's in bearish territory. The short-term sentiment looks pretty bad too. The near-term line still bearish. Momentum line at extreme lows. So pretty rough week for the dollar, and pretty rough as well for bonds. The TLT was up marginally, but if you look at the 10-year yield, after gapping down on the tariff news in the morning, we rallied and finished the day back above 4.5%, barely, but finished the day back slightly above that 4.5% level. So again, with the drop, bonds rally a little bit, and then finally, if you take a look at crude oil today. Crude oil also rebounded a little bit, had an up day back above a rising moving average, the intermediate line in bullish territory, so dark green shading and a red line. Gold's looking pretty similar, dark green shading and a green line, there as well. Intermediate line almost into bullish territory again. So a lot of these major, like bonds, commodity or gold, commodities, bonds not showing a bullish pattern, it's still bearish, but bonds and gold still showing a bullish pattern. Bitcoin still showing a bullish pattern. Stocks still bullish despite near-term weakness. Pretty strong bearishness on bonds despite the rally, and the dollar for that matter, despite the rally the bonds had here today. Let's take a look at the weekly market forecast for the S&P 500. So let's bring that up here. So again, a down week was a relatively down week here, but we didn't necessarily reverse too much of last week's. I mean, we just reversed last week's gain throughout the week, right? We didn't, get into that gap too much. So obviously it's brought the intermediate line still rising, is still up in the bullish territory. It's brought both the near-term line and the momentum lines down. The momentum line's oversold, but not to an extreme, pretty deep, but not below that 5th percentile. The near-term lines dropped below 80, but still in bullish territory, pretty easily in bullish territory. The intermediate line's actually still below market sentiment, so we still haven't necessarily crossed market sentiment. And this, again, in terms of how weak this correction has been, the market sentiment crossed below 80, and we're already almost back above it on the intermediate line. Like over here, when we crossed below market sentiment, we didn't get back up above it until way over here, when we had this bear tag. The market sentiment line was way in the bearish territory. Now, if I look at some of the other corrections that we've had since the 2000 or COVID, you can see that the intermediate line was down, in this case, down to 67 by the time we got the crossover above market sentiment and above the moving average. 2018, we were here crossing above the moving average and market sentiment. The market sentiment line was at 57. So, I mean, you can kind of get an idea that, here's 2011, crossing market sentiment, moving average, and 15 and 16. We were at 49 on the market sentiment. 59 on the market sentiment line there. And then you look at 2011, market sentiment was at 63 when we crossed above that. And also crossing over the moving average coming off that. So here, if we, right now market sentiment is at 78. So if we were to cross above that, it would be the highest level of the market sentiment line when we were coming off of a correction, right? with the market sentiment getting below 80. Even here in March, the intermediate line was nowhere close to the market sentiment line when it was just barely crossing 80, and we had that big strong peak up, pretty similar to what we have now, but getting to the moving average. When we got the bear tag and the August peak, the intermediate line still didn't get above market sentiment. So those are a couple pretty significant, quote unquote bear market rallies, actually more like correction rallies. But this was a failed pullback bounce in March, and then the correction rally there in August, and we had our next leg lower. So yeah, it kind of goes to show just how strong this rally has been to already almost be above it coming off of this correction low, right? When we had dark pink shading and a red line again on the weekly chart. If I take a look at these other weekly charts that we like to look at on the S&P, we finished the week. We did get a higher high, but we finished with a lower Hakunashi close. And considering right now we're trading at 58.02, the midpoint's right around 57.90. Like, we are barely above the midpoint, and we're definitely below 58.60, which is where the Hakunashi closed. So essentially, we are setting ourselves up for a transition candle. When you get a lower close, especially, we're setting ourselves up for a transition candle. The PPO is positive, but barely, so you got the golden cross. But the size of the candle obviously has declined. And like I said, transition doesn't mean reversal. It could be a continuation, but definitely looking for a transition candle, especially considering how bearish this week's candle was to get us to that lower close. The whole, let's take a look at the weekly chart on the whole moving average. And you can see that, again, that kind of weak candle, but we're still above the 20-week, below the 200-week, just like we were in March and not even close in August. The 200-week hasn't turned red yet, so it didn't turn red in March of 2022 either. The PPO is still below zero because we're not above the 200-week, but we are above in the average, right? The 20-period or 9-period average of the green line. The size of the candle down here you can see dropping well below the three-period average there. All right, let's take a look at the 3 green arrow chart. You can see that, again, we got red arrows across the board here. So, but we don't have 3 red arrows. We still don't have the arrow on the stochastics. We had 1 week of 3 green arrows on the S&P, and we've lost that this week, right? So if I take a look at, same thing, we still have 3 green arrows on the Qs. And again, it's not common, but you get the 3 red arrows and don't get the bounce. These are the kind of correction pullbacks. So when you don't get that bounce here and you stay pink for a while, you're in a correction mode instead of just a pullback mode. The diamonds, if I take a look at that, you can see, again, 1 week of 3 green arrows, and we're already back below the 30-week moving average. So that's something to keep an eye on. And then the Russell 2000 never did get above. I mean, we have 2 green arrows. We never did get that third on the Russell 2000. You can see it's still well below, and it has moved into the gap. The Russell 2000 has filled in that, filled it in actually, the gap from last Monday. Let's take a look at some of these other oscillators, like the DMI. The positive indicator it's dropping, but it's still above 25. The negative indicator is rising, but it's still below 25 itself. So it's not as bullish as we were, but it's not too bad yet. Nice thing is, it's been a pretty orderly selling this week. It's been a risk off move, but it hasn't been like a dramatic risk off move where we just like drop so much that we can't overcome it. We're not above 60 anymore, but we're still above 50, so we're still bullish. We're barely below zero on the CCI, and we did not get above 100 on the weekly CCI last week. We did not get above it. You can see that last week. And then this week we're really flirting with it, and we never did get above it. And we actually finished lower. So that's kind of an important development, because remember, once this gets above 100, then we can start the green box on this chart, and we're not there yet, obviously. The Ichimoku cloud still shows a mature bullish trend, so that's okay. We're below the green line, so a little bit of weakness, but nothing too major, and you see that as well in the 2-line version of the market forecast. we are below the 8-day, but we're not below that 17-day yet, which happens to be right at the 200-day moving average. MACD is negative, or below its average. It's not negative, it's positive, but it's fallen below its average. So any drop, below the 17-day moving average would be bearish, and when it has that combination there. Let's take a look at the Bollinger Bands and the Keltner channel. The band width continues to fall. It's falling pretty rapidly. The bands are moving. They're still ways away from the Keltner channel, so there's no chance for a red dot anytime soon. But you can see the momentum dropping, and that's normal, right? We're still in the upper half of the range, so we're not bullish, but we're not bearish yet. That's obviously a common theme that we've been seeing here. So here's the chart. We ended up finishing above last week's low, even though we gapped down below it. We did finish up above it. We failed to get above yesterday's low on the way back up, but we did fill in most of today's gap, so common gap. And we did not fill in very much of this gap, so which means that's probably still in play. And if you notice here, there's still a lot of volume above us, and there's very little volume below us. So again, the path of least resistance remains in the very short term to the downside. I showed you the range was relatively low, 6 points. You can see the average, the ATR is still above the 1.5% mark, but it's crossed below 2%. So it's not bearish anymore, but it's also not quite to the bullish levels yet. And the volume looks like it's stabilizing here. And again, this would be a pretty high level of volume, if it wasn't for this peak. So it's still relatively high itself. And then finally, the VIX finished above 20, finished above 22 today. Did not finish above the 95% mark. The VVIX came very close, but did not finish above 110. 110 is kind of that mark that, usually when we cross back above 110 after having been below, 100 and we make a run back up, usually that leads to pretty strong moves in volatility to the upside. So, whether or not this is enough and we can just round up, that's kind of the idea. There's no magical, reason that 110 is that number. So I don't know if it necessarily has to hit it exactly. I think we might be at least we might be close enough that we need to be aware of a potential jump in volatility here next week. Whether that's going to be because of Nvidia, remains to be seen. There's a lot of other a lot of retail earnings next week, a lot of technology company earnings next week as well. So we have an important week on the docket. All right, now let's talk about what's driving this price action. So let's bring up the asset class comparison chart here, and let's just take a look at today first, and then we'll go to the full week that was. But here's today. You can see gold up 2% today, big time move higher. It doesn't look like, as you saw on the market forecast, it doesn't look like that big of a move. If I go to the 2-line version of the 3 green arrow chart, you can see it's all pretty decent. Right? It's obviously back above moving averages. They're all rising. MACD is back to being positive. The stochastic's back above its midpoint. So it looks like we're bouncing, and a significant move because nothing else moved that much. Commodities were up slightly. Emerging markets, developed markets were up, and commodities were up, and gold is up as much as it was, because look how much the dollar was down. In fact, for a long time, good chunk of the afternoon, the dollar was the worst performing asset class. On this particular comparison chart. This is what the dollar looks like on its moving average. You can see big drop. So almost exactly the same chart as gold, just the inverse, right? MACD is negative below its moving average. Stochastics is into low and bearish territory. We're clearly moving below the 100 level. On the dollar. So clear bearish trend, and that's having an impact. Sorry, that's my Q&A from today. That's having an impact on gold and anything inversely related to dollars, whether it's commodities, gold, emerging markets, foreign bonds, whatever the case may be. The Qs ended up being the worst performing asset this week, and that's something we kind of watch, right? We watch the relationship of the Qs relative to IWM, and IWM for most of the week really struggled until today. So you can see a little bit of a drop, but still, way above moving averages, and even still above the, after opening below it, still above the 8-day moving average as well. Let me zoom out now and take a look at this week that was. And you can see, okay, I mean, gold's up over 5%, clear winner on the week. Real estate, interestingly enough, interest rate sensitive area was down because yields were up this week. If I take a look at the chart of the 10-year yield, you saw that it gapped down, but still finished above the 8-day average. If I take a look at the weekly version of this, you can see we were up. This is the 4th straight week that yields have been up. You know, we started that stretch right at 4.25%, and now we finished the stretch at 4.5%. So at the bottom of the current Fed funds range up to the top of the current Fed funds range, and above the closing above the close over here from that April 7th week where yields jumped up dramatically. Right, we went from 3.98 up to 4.49 up to 4.5 in 1 week. So you know, that's this move right here, right, when we moved up so much. So now we are here again. We are up above that level, finishing up above that level because we've had a good strong week in yields. And so you know, the Qs are down, the S&P equities are down, the dollar's down, bonds are down. If I go out to that, you know, that May 15th time frame when this whole rotation into safety started, right, with the U.S. equities, you can see that gold's still up 5.66% or so. But you can see equities are down 2%. The S&P is down 1.5% after starting a good chunk of this period, positive. But you know, emerging markets really underperforming developed markets during this time frame. The dollar significantly lower during this time frame, down almost 2%. Again, matching the declines that we see in both the Qs and IWM over that period. So very, very sharp drop in the dollar during a period where, you know, there's been some significant rotation. If you look at the sector rotation during the same time frame, you can see there's a clear shift to safety that started, you know, again, not this week, but last week, right? Thursday of last week. You can see the safety, you know, the market's down 1.5%, but those safety sectors are up 2% for utilities and staple, 2.5% for staples, over 1% for healthcare. You can see materials and industrials are not doing too bad because they started off strong, they pulled back, but they're still slightly positive. Real estate, communication services, slightly negative, but energy struggling, technology struggling, which is what we really don't want to struggle, and discretionary struggling as well. So you can kind of see the shift in the last little bit, and especially this week. Right, if we were just to go to this week here, you can see the shift towards safety. Like the market's down 2.5% on the week, roughly around that area, and you can see like energy's decline, you know, real estate's decline, interest rate sensitive. Financials decline, interest rate sensitive actually on the other side, but it's actually on the other side of utilities. Utilities are down but outperforming. Staples down but outperforming. Then you have materials and industrials also down but outperforming there. But really your biggest losers, again, are the biggest winners coming off of the low point, right? The April 9th low point. So these areas have been the biggest winners, technology, industrials, and discretionary. And so they're pulling back some, and these were the biggest losers coming off that low, and they've rallied some this week. And that's essentially, as of right now, that's kind of all it is. It's you know, we've had a good strong run on the zigzag chart, up 15.5%, and now we're just kind of giving some of it back. 2.7 is not that big of a deal. We're still above the 23% retracement of this rally. So remember, any kind of move in that area is not, the trend doesn't start, the pullback, doesn't start until you break that 23% line. Then you start looking for it to find some support at the 38 or lower, but it doesn't start. So, you know, this whole week has been a pretty relatively, you know, wild week, and this whole time we've stayed above the 23% retracement of that 15.5% rally off of the post-expiration low point that we had on April 21st, going into the post-expiration high point that we've had on May 19th. The Brent still doesn't look very good, but at least it's not deteriorating. It's negative, but it's not getting progressively worse, right? It's 29. You know, it's obviously it's getting lower, but the numbers that are really 21, 24, 29, those are all relatively low numbers. You have to get below minus 35 for there to be an issue there. And we're not, right? The number of stocks, interestingly enough, the number of stocks above their 50-day moving average actually held up. You know, still staying above the 300 stock limit here at 308. So still above 300, still above its moving average. The number of stocks above the 200-day moving average not holding up as well, so back below 250 and kind of slightly below its moving average. So a little bit of weakness there. Remember, we want this ratio to go up only if the number of stocks above the 200-day is significantly improving, right? If it's not, you know, this starts to, you know, go up because the 50-day is dropping faster than, you know, number of stocks above the 200-day. Then now we've got an issue, right? That would be a bearish increase. That's not typically normal whenever it has dropped as much as it has, right? When we've dropped this far, this fast, usually that means there's a lot of stocks climbing above the 50, and then that will be following, you know, the number of stocks breaking above the 200 would follow suit. That hasn't happened yet. So we're kind of stuck in limbo there. And if you look at the number of new highs and new lows on both the NASDAQ Composite and the New York Stock Exchange, it's still negative. Not very much, right? Very minimal, but still negative. So we can't get back above that positive 100 level and really kind of get going here in this. Mainly because of this little slide that we've been getting here this week. All right, well, that brings us to our trade idea of the day. So let's take a look at Zillow. New home sales really jumped up today, way more than expected. And so Zillow actually jumped up 1.5%. Now you notice, you know, short-term sentiment's rising, market sentiment's rising, but the intermediate line's falling. It's actually falling out of bullish territory. You're kind of alternating here between a, you know, red to yellow to green for a few days, back to yellow to green for a few days, back to yellow, back to red for a day, back to yellow. So, you know, kind of, I mean, we got a bull tag. We haven't broken down, but we haven't, you know, bounced off of it either. So it's, you know, it's kind of like, you know, there's a lot of like very neutral signs that the stock is going through right now. You can see that, you know, green arrow, red arrow, green arrow, red arrow. We're just fluctuating around the 10-week moving average here. You know, obviously, we're still slightly above it or the 10-week still slightly above the 40-week there at 0.78. But you see how it's gone flat. If you look at the 3 green arrow chart for Zillow, also kind of getting, you know, arrows, you know, green arrow, and then like 3 green arrows for a while, and then nope, then you don't only have like 1 green or 2 greens, and then 1 green, and then you got 3 reds, but not really breaking down too much on those 3 reds. Looking at the 2-line version, you can see Zillow right now is trading in between a couple significant, you know, a couple pretty sizable volume nodes. At the top of the value area here, and then right below it, heading into this low point that we had, the bear, you know, this correction low point that we've just had. If you take a look at the DMI and the ADX for Zillow, again, we're back below 30 on the negative indicator. We're back above 20 on the positive. The ADX remains below 20, so in trend ready state, so neutral state is essentially from a trending standpoint. The RSI is below 50, but not dropping below 40 yet, so technically it would still be green with this jump that we just had, and the above 60, but you know, you can see how it wasn't very much of one. And then you can see too that the CCI, like obviously it wouldn't be green technically because we'd stop it once it crossed below 50. But the CCI is down, you know, below negative levels, but not too negative. The weekly version of this is pretty neutral, you know, slightly negative there. The Ichimoku cloud, there pretty much is no trend going on, and we are inside the cloud. And then finally, if I take a look at the Bollinger Bands and the Keltner channels, the bands are, you know, very, very still, like extremely low. The bandwidth is extremely low, which means the bands themselves are really tight, way inside the Keltner channels, as we got some red dots and a switch to negative momentum, but not strong negative momentum there. So what I decided to do on this trade was to do an iron condor spread. So I go out to the June, which is more than 28 days. I sell the low 20 delta on the put side, So the 61 by the 59, sell the low 20 delta on the call side, sell the 72 by the 74 to keep it balanced. This is what it looks like when we take a look at the trade, and the break evens, as you saw, are on the chart here. So let's go back to a 1 year. There's my break evens, and the nice thing about those break evens is if we start flirting with either one, then we're going to get a trending move, right? Either to the upside here with a strong bullish move to the upside, or we'll be breaking support and making a run down to 48, 49. So either direction, that we'll want to make a trending move, and considering we're through earnings, we might be able to stay neutral here, right around these two significantly large volume nodes, right? So we might be able to, it would take a good breakout type move to get us either above these old highs or back below this correction low that we just had. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend and Memorial Day holiday, everybody, and we'll see you all on Tuesday.